A lot of traders apply trend lines for trading and making predictions on different financial markets. Trend line can also be an important element of a price action pattern. However, only the experienced traders know that some trend lines are better to be avoided. In this video, I will share with you the types of trend lines that you should avoid and you should not rely on for making trading decisions. Even the strongest trend lines may lose their significance with time. Before you take any trade from a trend line, make sure that it still remains valid. Have a look at that rising trend line. We can see strong bullish movements from that trend line, and for now it is definitely a strong vertical support. And once that trend line is tested, we will expect a bullish movement from that trend line. However, the price violated that trend line. You can see that the market dropped, we closed below that trend line, and we neglected that. Now that trend line turns into the resistance. That broken trend line is now a vertical resistance, and once the market is approaching that, we will expect a bearish movement from that broken trend line. However, look what happens next. You can see that then the price bounces, and you can see that that trend line is not respected again. That trend line here was neglected by the sellers first, and then by the buyers. I call such trend lines the invalidated trend lines. Once you see the trend line invalidation, my recommendation to you is not to rely on that trend line in future, and it is even better to just remove that trend line from your chart. And have a look, we have one more invalidated trend line on a dollar CAD pair. You can see that this falling trend line was a strong resistance, and 3 times in a row we saw bearish reactions from that trend line. Then that trend line was violated, and according to the rules, that trend line should have turned into support from where the price should have bounced. But instead you can see that that trend line was neglected first by the buyers and then by the sellers. That trend line became invalid, and in future it is better to not rely on such a trend line. When you are looking for a trend line to trade, remember that a reliable trend line should be confirmed by at least 3 touches and by at least 3 consequent bullish or bearish reactions to that. Here on WTI crude oil on a daily time frame, we have a perfect example of a solid valid trend line. You can see that that trend line is confirmed by 4 touches, and each time when the price is approaching that trend line, we see a significant strong bullish reaction to that. However, quite often newbie traders trade the 2 touches based trend lines. For example, here in Aussie dollar, you can see such a trend line. That trend line was respected just 2 times in a row in the past. It is 2 touches based trend line. And you can see how easily the price violated that trend line. Once we tested that, we simply went lower. And it is the perfect example why the 2 touches based trend lines are better to be avoided. Moreover, if you start relying on the trend lines that are based on 2 touches, quite quickly your chart will start looking like a complete mess, because there always will be a lot of trend lines that will meet such criteria. Take a look at dollar Swiss pair. On a daily time frame, here there are a lot of trend lines. If you consider the 2 touches based trend line, your chart will always look like that. There are the trend lines that go against your trade with time still remaining valid. I call such trend lines the receding trend lines. Have a look at that falling trend line on New Zealand Swiss pair. You can see that that trend line was respected 3 times in a row in the past, and definitely it is a strong vertical support. We see the touch of that trend line at the moment, and of course probabilities will be high that the price will bounce from that trend line. Depending on your trading style, you may open a swing trade on a daily time frame from that trend line, or you can open a day trade from that trend line. And the main problem here is that the direction of the trend line is against the direction of your trade. We are buying here, we take a long trade while the trend line is going lower. And with time, the price may keep sliding around the trend line. The price may easily go lower, respecting the trend line. And most of the time, you will be stopped out from the trade before the market will start going in the desired direction. You can see that here, the price was falling for 5 consecutive days, perfectly respecting that trend line, and only then growth initiated. When you're planning a trade from a trend line, make sure that your trade direction matches with the direction of the trend line. You can see that here on New Zealand Swiss we have a very perfect falling trend line. It is a falling resistance, and from that trend line we can take a short trade. Taking a short trade, we will expect a bearish movement, and that will match with the direction of the trend line. Trend lines can provide very safe points for trading entries. However, the trend lines are not equal, and while some of them can be very profitable, trading some of them may lead to substantial losses. Let me know, traders, in the comment section if you have any questions. Also, traders, if you want to learn how to trade, if you want to learn technical analysis, do not forget to check my premium group, the link in the description below. Traders, thank you so much for watching, and do not forget to watch my other videos.